Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending October 25th, 2024. So the highlight of the week, of course, was the Bank of Canada that came with a jumbo rate cut of 50 basis points, so two cuts in one. We were not surprised by the move. The market wasn't surprised by the move either. When you look at the Canadian economy, you see that inflationary pressures have subsided outside of shelter, pretty much disappeared. If you look at per capita growth, per capita consumption, you're seeing weakness across the board Canadian economy. So it's truly a race to the neutral rate in the country. Three cuts this summer, now 50 basis points, so that's 1.25% of cuts already in the books. Our base case scenario is that they will be cutting by 50 basis points again in December, because if it's a race to neutral, we'd be surprised to see enough evidence that would change the Bank of Canada's mind by December 11th, which is the next date for the decision by the Bank of Canada. And also we're starting to open the door for a third consecutive 50 basis points cut in January, which would bring the monetary policy rate pretty much at neutral. And even we could think that after that, terminal rate could be about 2.5%, so the lower end of the band that is the neutral rate that they estimate from the Bank of Canada, which is between 2.25 and 3.25. So we think it would make sense to support the Canadian economy by going near the bottom of this band. So more on that in a few minutes, but looking at the markets activity this week, lots of red on the screen. So what's happening in the markets is that, well, markets are recognizing the renewed strength of the US economy, rather. So this is pushing global interest rates higher, but it is the pricing in of the election likely outputs or outcomes, rather, that is pushing the markets higher. So now we're seeing momentum swinging towards a Republican sweep. So that would mean Donald Trump victory for the presidency, Senate and the House going to the Republicans as well. If we have that, that means tariffs are coming, or at least threats of tariffs, more expansionary fiscal policy, more inflationary fiscal policy, so higher interest rates. And now we're seeing that the upward move in interest rate is starting to weigh on the stock market as well, with negative performance on the week there as well. One highlight that continues to shine is the price of gold, higher again this week, up close to 33% this week. When you look at global surveys, you're seeing more and more interest in gold, and when you're looking at global flows, you're seeing lots of money and even accelerating towards gold. So maybe there's even more momentum that could be sustained here for the price of gold looking forward. So getting back to the Bank of Canada, so jumbo rate cut, that's 1.25% of cuts since June. So that's pretty sizable. There were good reasons for the Bank of Canada to start accelerating. As I mentioned earlier, we think it's the right thing. We are satisfied with the call. We think that the terminal rate is somewhere around 2.5%. And if the Bank of Canada could get there as quickly as possible, that would be the optimal scenario. So if you look at the details on inflation, on the left you have the contributions to annual inflation. So every component of CPI has a color here, and if you look, what's dominating the recent figures is shelter, and shelter is one thing where the Bank of Canada cannot target directly in a context where it's driven by demographic growth, which is historically strong. Now there were some changes announced to the immigration policy this week, which should make these pressures subside with time. But if you take away shelter from the total CPI, you get the chart on the right, you have less than 0.4% annualized inflation right now. So Bank of Canada is seeing these. They feel also that it's time to get back to neutral as quickly as possible, because as was said in the opening statement, the goal now is to keep inflation low and stable. So that means that you need to keep it close to 2%. You don't want to go into deflation territory, and that means a rush to a neutral rate. So we think that there's few more 50 basis points cuts coming, at least one in December. This is our base case scenario. Maybe a second one in January. Looking at what the market is pricing in right now, market is pricing 1.4 cuts in December. After that, a pretty stable pace. But if you look at the table on the right, you said the market is not seeing things exactly as we are right now. We are thinking 50 in December, likely 50 in January, and then after that, that would take us to 2.75, and maybe one more 25 basis points cut to get us to 2.5, and that would be likely sufficient for now. But the market table on the right showing that the market's seeing 60% odds of a 25 basis point cut in December, 40% odds that we do have a 50. After that, in January, another 25 basis points cut. In March, another 25 basis point cut. And then after that, a wide range of possibilities for April. So the market is not pricing that completely, but we believe that the data should fail to surprise positively enough to change that mindset that the bank seems to have right now from the communication and from their actions, that it's a race to neutral. Again, a race to neutral. 2.75 is the midpoint of neutral. We think 2.5 would make sense. We should get there by the spring. This is what we would recommend to the bank. So that's it for the Bank of Canada. Maybe now the road to the presidential election. So two charts here. The message is that it's getting tougher for Miss Harris. The math is getting unfavorable to her, but we're still, there's it's still a very tight race in every single swing state here. So you have the battleground states on the left. If you take them one by one, you can say, well, it's very much neck and neck. But for Miss Harris to really win this election, she needs to win more than one of those states. So she needs to, so it's more about the joint probability here. She needs to make solid gains in many of those states, and winning one state and a second and a third and a fourth, the odds are falling pretty quickly here based on the momentum that we're seeing here. So the chart on the right showing that, well, Better's market is reacting to that. Now the most likely scenario is that we have a Republican sweep, but again, pretty much again within the margin of error between the Republican sweep and a divided government. So the election is on November 5th. It's in about 10-11 days right now. Nothing is done, but the momentum and the vibes, let's say, in the last 2 weeks before an election tend to be important, and we need to acknowledge that there's breadth here in the momentum towards Donald Trump. So likely what that means is that there's going to be now the surprise would not be a Trump win. A surprise would be strong gains from Mrs. Harris, and that positions the market to be surprised if we fail to have as much gains on the Republican side, and the volatility could come from a Harris win rather than a Trump win. So this is what that means. So the market has priced in a lot of the odds that the Trump win happens, not completely, but now the surprise would be a Harris win. So still very tight. It's going to be an interesting race. We'll cover that next week again, as we'll be very close to the election in a week. So what we'll be watching next week, Bloomberg Nanos consumer confidence for sure. Since the bank started cutting rates this summer, we've seen consumer confidence perk up. Very good signal for things ahead in 2025 in the country. It shows that monetary policy is working. There's a breath of fresh air for consumers, and there's more confidence. Good news, GDP growth, this is from August, so slight but positive growth is expected. In the US, JOLTS job openings survey, a very interesting indicator to measure the slack in the labor market. There was a growing slack recently in the last month. We had some gains there, so gave confidence to the market that the labor market is not hurting too much. Let's see what we get here. Core PCE inflation should be reaccelerating on a monthly basis, 0.3%, 2.6% year over year. Is that enough to change the idea of the Fed that they need to cut at the next meeting, which is just after the election? Likely not, but the pace of disinflation in the US is let's say less abrupt than in Canada. Will the Fed cut at every meeting going forward, or will they start taking some meetings, some breaks in once every other meeting? That's a very important question. So of course a lot hangs on the election night, but still the disinflation in the US has slowed down versus what we've seen in Canada. Non-farm payrolls and numbers should be impacted by the recent hurricane season. So 120,000, that's on the low side. Unemployment rate should be stable, and manufacturing should still be in contraction territory, but getting a slightly better here. So that wraps it up for the week. Always a pleasure to serve you. If you enjoy the content, please share, and of course, come back again next week.